So good evening, everyone.
Good evening, sir.
Welcome to another class with Equity Professionals. My name is Wasil again. I'll continue with my part on financial reporting today with a fresh topic. Today, we are going to be looking at IS 1 on presentation of financial statements. IS 1 on presentation of financial statements. So what do we have in front of us today? For presentation of financial statement, we are going to look at, first, we'll briefly look at the objective of this standard. Then, I will look at financial statements and its general features. Then, I will look at the structure and the content of financial statement. When we are done with that, then we'll solve questions on how we present financial statement. If you would remember, if you started this class with us, I told you that the objective of financial reporting is for you to be able to prepare and present financial statements as far as your exam is concerned. When you're entering that hall to write this exam, it's assumed that you are already an expert in preparing and presenting financial statement. So today, what I want to show you is just the structure and the content of a financial statement. Then I will show you some questions and how they are presented in the books. This standard has a long history, a very long history. It has been in existence since like 1975, and it has grown. The most recent update on this standard we are looking at today was in June 2011. So looking at the history of this standard we are looking at. Now, you see, when it comes to IS 1 on presentation of financial statement, the objective of this standard is majorly to prescribe the basis for the presentation of financial statements. It's just to show you how we present, just the basis for the presentation, in such a way that entities can compare their financial statements, and they can even compare their financial statements with previous period. They can compare their financial statements with one another and also with previous period. So the objective of this standard is to show you, to give you a background on how we present financial statement. So as far as this standard is concerned, IS 1 does not set out, does not deal with recognition, measurement, and disclosure requirements for specific transactions and events. IS 1 doesn't deal with specific transactions. It doesn't show you recognition and measurement. Like, I know Mr. Kazim has taught you income tax. You see, taxation, both current tax and deferred tax, they are a transaction. So IS 12 deals with recognition, measurement, and disclosure of income tax. IS 1 is different from that. It doesn't deal with specific transaction. What IS 1 wants to do for us is just to show us, okay, how do we present a financial statement? And of course, IS 1 does not consider itself with interim financial statements, which is outside the scope of this your class anyways. Anyway, so that's the objective and scope of IAS 1. Now, having understood that what we want to learn in IAS 1 is presentation of financial statement, then you need to understand that a financial statement itself is a structured representation of the financial position and financial performance of an entity. So everything you'll be learning in this class, everything myself and Mr. Kazim is teaching you in this class is all about financial statement. And that financial statement is just structured. You see, IAS 1 is what helps us structure it. It gives it a format, a structured representation of the position and the performance of an entity.
Hello, I can't hear you.
Sorry. So as I was saying, that financial statement is a structured representation of the position and the performance of an entity. And the objective of a financial statement is similar to what you have learned under the conceptual framework. It's just to provide information about position, performance, and cash flows to be useful to users. And also it shows result of management stewardship. So now, when it comes to financial statement, it has components, a complete set of financial statements, or the component of financial statements comprises of the statement of financial position, the statement of profit or loss and other comprehensive income for the period, the statement of cash flows, the statement of changes in equity for the period, note comprising of a summary of significant accounting policies and other explanatory notes, and statement of financial position as at the beginning of the earliest comparative period, when an entity applies an accounting policy retrospectively or makes a retrospective restatement of items in its financial statement. Okay, so we're going to spend a lot of our time on this complete set of financial statements. From the statement of financial position as at, we will prepare a lot of it, to the statement of profit or loss. In fact, this statement of cash flows, it will be taught under a separate topic, under IAS 7, which I think will be like the third topic Mr. Kazim is going to teach you, IAS 7. Then statement of changes in equity would look at a lot of it. Then notes comprising a summary of significant accounting policies. So most of our workings, when we start applying the specific standards on on presentation of financial statements, we would show you how to present notes. So for your level, it will just be in form of workings. And we are going to introduce you to accounting policies. We would teach you what it is under IAS 8. Accounting policy are usually disclosed in the notes to the financial statements and some other explanatory information. So then this one, you will learn it. You might not really get it so well now, but you will learn it when I teach you IAS 8. You will see that sometimes you could make some mistakes when you could have made some mistake in previous year's account that you're only discovering in the current year. So there are ways to correct that, because it's not possible to change figures of accounts that you have published. So we would usually require that you prepare some additional or opening statements of financial position. We would talk more on that as we move on in our studies. But as far as financial statement is concerned, this is a complete set of financial statement. Then is the features of a financial statement. The features of a financial statement. Number one is fair presentation and compliance with IFRS. Number two is going concern. Number three is accrual basis of accounting. Number four is materiality and aggregation. Number five is offsetting. Number six is frequency of reporting. Then comparative information. Then consistency of presentation. So these features, you would see them again as we move on. However, you need to have them at the back of your mind because they are what guides us when we are preparing our financial statement. Every financial statement would generally have these features. They will be present there. They have to be present. And the most important one is that all financial statements must be presented fairly. And of course, presenting fairly, it also means compliance with IFRS. And when I say fair presentation, is similar to what I mentioned under fundamental characteristics when we're looking at the conceptual framework. Under faithful representation, it's the same thing. So fair presentation and compliance with IFRS. So when we talk about presenting fairly or rightly, it requires that the entity must select and apply an accounting policies. The way financial statements are prepared is that all material items, all key transactions must have an accounting policy. They must have an accounting policy. Again, accounting policy is just a way an entity applies accounting standard. I don't want to go so much into it yet because it's a topic on its own on IAS 8. So, but what I just need you to understand is there's something called accounting policy. And every item, every material item, like there's always an accounting policy for revenue. And accounting policy for revenue for entity A might be different for an accounting policy for revenue for another entity. So all of them would, of course, and when developing accounting policy, it has to be in accordance with the standard that deal with that transaction, right? So every item, there's an accounting policy. So you must select and apply an accounting policy. And when you select those policy, you must present your information and those policy in your financial statement in a way that you would provide relevant, reliable, and comparable information. And you would also provide additional disclosures when it is necessary, where just complying with an IFRS will not provide sufficient information, that you will need to give people additional information. Then you need to provide additional disclosures where necessary. Okay, so I mean, when looking at fair presentation, it's just a distinct way of really referring to what we discussed under faithful representation, where it was talking about completeness, like you need to ensure that all information are presented. You do not omit anything, and it should be, there should not be omission, and it should be free from error. All of that, this is a bit similar to it, but this is more distinct, specifically referring to the fact that, okay, there's something now called accounting policy that you must apply, and you must present your information in such a way that's relevant, reliable, comparable, understandable, and provide additional disclosures where necessary. Okay, so that's fair presentation and compliance with IFRS. Another feature is going concern. So when you are preparing your financial statement, at the end of every year, you as an accountant, the management must always assess whether the company can continue to operate as a going concern. At the end of the year, you must always assess. Because why it is important you assess, which is what this paragraph 1 is really talking about, that management must make an assessment of your ability to continue to operate as a going concern. And when you're making this assessment, if your company is a profitable organization and it has capital, it has money, that is a positive indicator. You can easily conclude that nothing is wrong. You will continue to operate as a going concern, nothing, that you are okay. If you are making profit, you have an history of making profit, and you have money, you have capital. Even if you have finished, if you have burnt your capital, you even have access to raise additional capital if you want. Then your going concern assumption is appropriate. You don't need to tell us a lot of stories. However, where there are material uncertainties that may cast significant doubt upon an entity ability to continue, then you need to tell us. You need to disclose it, right? If you're an entity, for example, now that you import goods from neighboring countries. In 2019, the Buhari government there was border closure. And that border closure resulted in a lot of businesses, they had to shut down, because if you are unable to import, if that's your sole primary activity, importing products from neighboring countries, and you can't import, there is a material uncertainty that will cast significant doubt on your ability to continue, or there is restriction in your ability to get foreign exchange. You are an import-dependent company. You usually would import or you sell, and you cannot have access to forex. It is a material uncertainty, right? So a lot of things, like if governments make a policy, for example, and you see that it would impact on your organization, then it could be a material uncertainty. So a lot of things could be a material uncertainty. So you as an accountant, you need to be aware of those indicators. If you see any of them that would affect your company, don't just prepare financial statement like usual. You need to state it that this, and this might affect our going concern. It's important so that users can make the right decision. So, you see, why are we making assessments? Why are we concerned about whether an entity can continue to operate? You will learn that all of the standards, all of the principles we are going to learn in accounting, the backbone is the fact that this company will continue to operate. In fact, the backbone of accrual basis, the backbone of accrual basis is that you will continue to operate. You see, for the fact that you can recognize income when you have worked for it, right? Even when you have not collected the money, right? Is just based on going concern that, okay, you continue to operate and you collect your money. For the fact that we are saying that when you buy an asset, right, that you are going to use for many years, okay, we are saying don't recognize the entire cost of that asset in P&L this year. No, maybe you continue to operate. So put it, you put it in your position statement. Then recognize only a portion as expense. They call it depreciation. It's on the assumption that you will continue to operate. And almost all the figures, even though they are historical transactions, but their recognition basis and measurement criteria is is premised on the assumption that this company will continue to operate as a going concern. You will see it. So that is why accountants, right? All of these things you're learning, it's based on going concern assumption. It's based that, okay, this company, will it continue to operate? You need to know. You need to be able to assess. So, and that's why we say that any company that has history of profitable operation and ready access to financial resources, that entity can conclude that is going concern assumption is appropriate. So in every financial statement, you must make a comment on your going concern assumption. Is it appropriate or not? Let us know. What's your basis of your judgment? However, if you look at things, you look at your environment, things are not, there are material uncertainty. You cannot prepare your finance on a concern basis. Then you need to tell us, you need to disclose it. And you need to tell us what is the basis, what's now the basis on which you are now preparing your financial statements. And you need to explain to us why do you think you won't continue as a going concern. So you see, IAS1 intentionally did not mention whatever basis you choose afterwards, right? So, but there's a popular basis we call break-up basis. So break-up basis. So it's a basis where a company is about to be liquidated. And on that basis, all of its assets, they will no longer be recognized at costs. They will no longer be recognized at any other basis, not even current value. They will only be recognized at how much they can sell them immediately, their realizable value. That's liquidation basis, but it's really not within our syllabus. But there is something called breakup basis, which I need you to note. Of course, severally I kind of asked this for like 2 marks. So next is accrual basis. I've mentioned this while I was explaining going concern. So financial statements are prepared on an accrual basis, except for cash flow information. When IS7 cash flow statement is not prepared on accrual, it's cash. It's cash, except for cash flow. So, and accrual basis, you are using accrual basis when you recognize your assets, liabilities, equity, income, and expenses, when they meet the definition and recognition criteria for those elements. I hope you remember the definition of each of these elements and their recognition criteria. You see, following that definition and recognition criteria is accrual basis. You see, I mean, another way of looking at accrual basis for foundation level, right, is that you recognize income when you earn it and not when you receive cash. You recognize expense when you incur it and not when you pay cash. Okay, so when do you recognize asset? When do you recognize liability? When do you recognize equity, right? So at your level now, as skills level students, you need to go beyond that and understand that accrual basis is used when you recognize assets, liabilities, equity, income, and expenses, when they meet the definition specified in the conceptual framework and also the recognition criteria as specified in the chapter 5 of the conceptual framework. That's accrual basis, because when you pick those definitions up, like for assets, you said is a present economic resource of an entity, okay, and that is controlled by the entity. Then you recognize it in your books as soon as you have a present economic resource and you have control. So nobody is making mention of money or cash flow. Just let there be existence of an economic resource and you have control over it. Liability, when you have an obligation to transfer economic resource, recognize it in your books. That is accrual basis. No mention of cash. but occurrence of a transaction. Then you put these items in your books. That is accrual basis of accounting. I will need you to upgrade your knowledge to this point here, and you can revise it over and over again to get used to this. The accrual basis is used when you're recognizing elements of financial statement only when they meet the definition and recognition criteria of those elements as specified in the conceptual framework. Then another important one is materiality and aggregation. You have heard of materiality before when I mentioned relevance. I told you that the relevance an item is influenced or determined by its nature and materiality. And I explained that. Somebody even asked, what is nature? What does it mean? I told him it's the same thing as materiality. It's already captured indirectly. So here again, IS1 is emphasizing that when you are presenting your financial statements, you need to identify items that are material and are similar. Material class of items that are material and similar. You need to present those ones separately. You need to present those ones separately. So any items that are material and similar, present them separately. And items that are dissimilar and are immaterial, okay, most of those ones you would eventually, especially if they are immaterial, they are not so in terms of their value now, you can aggregate those ones together. You can aggregate those ones together, meaning you would present them also as a singular item. So materiality is saying that when you have material class of similar items, aggregate them. The ones you present them, we are going to present them separately in your financial statement, in as much as it's material, so that users can really see it and make decision on that. And again, where there are immaterial items, then aggregate those ones together. You don't have to present everything as a one-liner. There are some items you just aggregate and just call them. You don't have to present them separately on the face of the account. And when I say on the face of the account, it doesn't mean in the P&L. You are talking about the notes. There are some items that even in the notes, you don't have to present them separately. You can aggregate them together. So ultimately, it will depend on their materiality or immateriality. So the key thing here is that any item that is material, you have to present them separately. Present them separately. Another very key one here that we take very seriously in financial statement is offsetting. We don't offset assets and liabilities or income and expenses unless they are required by an IFRS. Don't ever offset. You as an accountant, you cannot say, okay, my company is owing this guy or this customer. My company owes him 100 naira. My company owes him 100 naira. But he too, he owes us 50 naira. So we are owing one another. We are owing him. He's also owing us. So you now offset. You now present a net 50. No, we don't present accounts like that. If your company is owing somebody, put it there, whoever the person is, that, okay, we are owing somebody. If the same person you are owing is also owing you too, put it there, that this person is owing me. That's why we have payables and receivables. Present them separately. Don't offset. We don't permit offset, except where they are specifically required by IFRS. However, you need to understand that when we are talking about offsetting, don't mistake it with when we are measuring assets, net of valuation allowance. We will do this a lot. We will do this a lot. Like, for example, now we usually remove damaged inventory from our inventory. That is not offsetting, no, because we are not offsetting there. We just have to remove damaged inventory from our total inventory. Or when we remove some of our receivables that might not pay, or even when we remove depreciation from the cost and we present carrying amount, that one is not offsetting. Those are measuring assets, net of valuation allowance. Those ones is not offsetting. Okay, so don't mistake that with offsetting. However, I kind of asked this before, that examples of offsetting that are permitted by an IFRS for 4 marks. Wow. You see, one is gains and losses on disposal of assets. We usually present it on a net basis. So when you sell an asset now, you will not find anywhere in the financial statements where we present, okay, sales from. What we usually present is gains or loss on sale of that asset. So it is in the notes will now show that, okay, that gain is just the sales minus the cost or carrying amount of the asset. But the only item we'll present is gain or losses. Yes, that one is permitted. It's offsetting really, because we're offsetting the sales with the cost, but that is permitted. Another one is that when you are presenting foreign exchange gains or losses on a net basis, that one is too is offsetting, but those ones are permitted. You are allowed to make those type of offsetting gains or losses on non-current assets, foreign exchange gains, and losses. I would have loved to teach you. Of course, I will teach you about this first one. After today now, my next topic is IS 16. So I'll definitely teach you this. But I'm not going to teach you this foreign exchange gains and losses. Or if I have extra time, I might teach you IS 21, right? Because of what is happening in the economy now, the volatility and the devaluation of the naira. So exchange gains and losses is more popular right now, especially now that a lot of companies are keeping their position in foreign currency. So accountants, we need to know how to recognize foreign exchange gains and losses. Well, but your syllabus is not there, but when you get to advanced classes, we definitely are going to touch it. So that's offsetting. So don't forget, we do not offset. But offsetting is different from measuring assets net of allowance, like carrying amount, like removing damaged asset from inventory, removing allowance for receivables from receivables, impairing assets, removing depreciation from cost. Those ones are measuring net of valuation allowance. That one is not offsetting. And again, these two are offsetting, but they are permitted. When you make gain or loss, or when you sell, or when you present gains or losses when you present foreign exchange gains and losses, those ones are offsetting, but it's permitted by the IFRS. Another important one is frequency of reporting. So when we are presenting our financial statements, the requirement is that we present it at least annually. Of course, internally, within your organization, you can do your monthly management reports, you can do your quarterly reports, but for the users, at least annually, every year. So, and when you are not presenting financial statements, like in Nigeria now, it's allowed, especially for tax purposes, when you're just starting a business, you can present a period lower or higher than 12 months in your first year. not only in your first year, the year you are also liquidating. Okay. And for whatever reasons why you have to prepare, and you will learn later that under consolidation, right? When the dates of the parent and the subsidiary are not the same, IFRS 10 allows the subsidiary to make adjustment for like extension. It can extend in such a way that his accounting date will now be the same with that of the parent entity. So you will learn that in consolidation, but a lot of reasons. But the point here is this: when you are not presenting your financial statements annually, you need to let us know that okay, these financial statements then is not prepared for 12 months, and that means you cannot compare fully with that of last year, especially if you are preparing, let's say, 18 months this year, but last year was 12 months. So let user know so that somebody will now be comparing revenue of that your 18 months with revenue of 12 months. They are not comparable. So when the period is longer or shorter, let us know. But all things being equal is 12 months. That's frequency of reporting. And second to the last year is comparative information. Another feature here is that every financial statement must have at least 2 years. At least 2 years, the current year and the previous year. So the only situation when you can have 3 years is where there is a change in accounting policy, okay? Where there is a change in accounting policy that you have to apply retrospectively, or where there is a retrospective restatement of an item in the financial statement. Again, I've mentioned this before when I was talking about the content or the complete sets, the component of a financial statement. So when I teach you IAS 8, you would appreciate this one better. But just know for now that when an entity changes an accounting policy, you would have to apply that change retrospectively. So in such a case, the entity will be required to prepare 3 years statement of financial position. 3 years. But I mean, we will learn this specially. So that's comparative information. The most important thing here is that you need to present at least 2 years financials, both figures and explanations. Don't forget, for every figure, there is a note. So even in your notes, present the comparative information. Present note for previous period, not just for the current year. Finally, here is consistency of presentation. We are so particular about this that you must retain presentation and classification of items from one period to the next. The way you present and classify an item is how you must continue to present and classify them. And majorly is for comparability, unless where there is a change in the nature or the way you operate, right? Or probably another presentation format or classification format is more appropriate. But it has to be significant. Well, we don't want it to be changing. It will affect comparability, right? So don't change the way you present and classify items, except there's a significant change in the nature of your operation, or there is an IFRS that requires change in presentation. If there's an IFRS that requires change in presentation, then fine, why not? Before now, there's a standard called IAS 23 on borrowing costs. The way we used to present it was either expense or capitalized based on certain criteria. But now, all borrowing costs are capitalized. Borrowing costs should be capitalized, of course, if they are directly attributable. So it's a change required by an IFRS, right? Then you can change your presentation format. Okay, all of these I've been discussing, you would see them practically when we start preparing financial statements, and you will see them in your exam under section C, where they will ask you to explain any of this. But these are core features that these are the first things you have to learn and learn very well, that would make you understand a lot of things we'll be teaching you. It will make it make sense to you. So please know about fair presentation, know about going concern, know about accrual basis of accounting, materiality and aggregation. I mean, every item you see presented separately is material. Don't just, financial statements should be advanced beyond just presenting everything. It's material. Offsetting, you don't just offset, frequency of reporting, comparative information. I mean, when you see us preparing 2 years account, don't be surprised. And consistency of presentation. The way you present this year is how you must continue to present that. You will see that is how we operate in reporting. You don't just change things. It's just solely for comparability. So that's the general features. So the final thing under IS1 is this: the structure and the content of financial statement. How does it look? What is inside of it? So we're going to use these 3 guidelines for the structure and the content. First one is identification. Second one is the current, non-current distinction. And the third one is classification of expense by nature or by function. I'll just glance through it. But I'll spend most of my time on the structure and the content. So this is sample financial statements that has most of the items we are going to be faced with as we move on in this class. So the first one here is the statement of financial position. So we have assets, non-current assets. Then after your non-current assets, you have PP, goodwill, intangible, investment in associates, financial assets. All of this are under non-current assets. Then we have current assets, inventories, trade receivables, other current assets. There could be more, but we leave it as this. Then we have total assets. So for these assets now, this asset section, the only observation here is that you will see that the asset is classified based on current, non-current, and the non-current is starting first. Okay. All right. So somebody wants to ask a question, please ask.
Okay. I wanted to ask, and this got to do with the accrual basis concept.
Which one is that?
So, the accrual basis.
Okay.
When you talk about the concept, please,
Okay.
can you take it back to that section? Please.
Okay.
Okay, thank you. So, instead, an entity shall prepare its financial statement except for cash flow. You need the accrual basis of accounting. So when that there is for assets, liabilities, equity, income, and expenses, satisfy, and all of that. But in reality, when you do that, so when you have satisfied you are fully satisfied that you have earned, the company has earned that, but it has not actually been, you've not received it, but probably the job and the project has been completed.
Hello, sir. Hello, sir.
Yes, sir. We can hear you.
Sorry for drawing the class back. Please, how can we get this part?
Oh, I will forward. We have shared it on the group. Maybe you are new to the group. Let me immediately re-forward it again.
Thank you.
Yeah.
Okay.
Yeah, please continue. Okay.
So So having done that, and you report when you report the reporting is done on accrual basis, right? For tax purposes, for income that you report both what you've received and what you've yet to receive, as in physically in your bank statement or your financial statement, the company's bank statement, and you now report that at the end of the financial year. So what then happens? Because the tax authorities will whatever you report will be taxed. So you're not going to be taxed for what you've not received, and you may payment for what you've not received. So what happens if there is now a default in payment resulting in bad debt, or you're not paying? Don't you think that as a company you'll be overpaying tax for the financial year? Considering the fact that what you have physically is less than what you have reported.
Okay, thank you very much, Orobo. Is your name Orobo? Because
Yes, it's my name.
okay, thank you very much. That's a very matured question. Yeah. So, I mean, for the benefit of the class, is saying that we are recognizing revenue that you have not collected. Are you not going to overbloat your profits? And the tax people will come. They would slam your entire income as tax, and even your expenses that you have not paid. The taxman might not allow it for the fact that you have not paid, then they will say they will not allow it. So that's relating to tax, right? So that's a very intelligent question, right? And so practically speaking, right? Practically speaking, all of these things would ultimately net off one another, practically speaking. So first, the most obvious one is that ideally, receivables, when you sell, you should collect your money within 1 year. You should collect your money within 1 year. So that's why most entities would maintain an age receivables. So an age receivable, like a table. So it's not something that will take long before you would actually are able to collect it. So even though right now the taxman, when it comes to revenue, is more focused on your invoices rather than have you actually received it. Even though they work with bank statements, yeah, they would collect your bank statements, and those guys will eventually look at what you actually came in and would put that in as your income. They will also they will have different bases. They will use bank statement basis. They will use control account basis, meaning your receivables. They will use your invoice basis, and they will pick the highest. In fact, they will use their own portal as a basis. So they use different bases, right? But ultimately, they will net off that you would not be unnecessarily taxed, right? And when it comes to expenses again, right? The starting point here is this. When it comes to items like withholding taxes, if you look at the new regulation that came in now for withholding tax, it's now very clear that you would only withhold at the earlier of when you make the payments or where the transaction is otherwise settled. So now is more focused when it comes to withholding tax on when you have made the payment. So withholding another person's payment when you have not, so the taxman requiring you to withhold when you have not actually paid doesn't exist anymore. Before now is when the transaction occurs, but now it doesn't exist. But eventually, when it comes to CIT, right? Most of these things, when you give them your GL, right, they will just want to say, okay, where is the backup evidence? When you give them your payment voucher, right, they will look at it. They will look at it. And when you explain to them that this one I've not paid, and they can see the payment voucher, they can see the history of transaction with the person, they will give it to you. So all of these things have been working seamlessly in practice. And of course, the tax system keeps improving over time. But ideally, in an ideal situation, the fact that the accrual basis is within 1 year, your transactions when it comes to income and expenses, you should have received and make your payments within 1 year. Otherwise, you will not find them. That means they are non-current.
Sorry, sorry, I'm just let me go back again. So
Okay.
as in regards PBT, PAT, you report this first, then you make payment before the tax man come in, or you make payment or whatever is the lowest or whatever. You report your profit for the year as a company, to the FRS. In that instance, right, is it right? Because now you are reporting, oh, this is our profit for the year. Also reporting, if you use the accrual basis and you're reporting for money that you're not putting in your account. I just want just some sort of clarification. I know in reality there is all adjustment and all that, but theoretically now doing this and you go by the books like this, do you think it is appropriate for an organization? Yes, don't you think that more taxes, the company will be paying more taxes in that instance than it should?
Yeah, again, so we, accountants, we report economic activity, and the taxman also would also agree with economic activity in most instances. So, except when they want beyond reasonable doubt that did you actually carry out this activity? And you would never pay more tax, right? Because if you have reported widely, I mean, if you have done the job, you will recognize revenue. And accounting also allows you that, okay, if there is now any indicator that you might not collect your money, then you expense it through bad debt. In fact, that's why there is even allowance for doubtful debt. A portion, that allowance is like, okay, a portion of this money I'm expecting might not come. So you'll be expecting some of your receivables, which will also help you reduce your profit, as the case may be, even though the taxman will ultimately disallow that for allowance for receivables if it is a general one, except when it is specific, and they can narrow it down to a particular customer, and you can show them evidence that this person will not pay. So when it's a specific bad debt, then of course they would even allow it as a deduction for you. So but ultimately you would not overpay, ultimately, because again, these transactions next year, when you are actually now paying, or when you're actually now collecting the money, you know that you should not show in your P&L. So that is what I meant by everything would be resolved eventually, right? And all of these items that you are suspending, don't forget they are in assets, they are in liabilities. So eventually they become income. Some of them become expenses. So just today we are recognizing as income and expenses because we did not collect money. By the time you collect the money, it's not like you would record additional income or additional. So would you say that, okay, now that we're not paying money or we are not receiving money, so we are underpaying tax? So for us accountants, we recognize economic activity. So the taxman also now has gotten used to even doing that because it just makes life easy for everybody. I don't want to go too much deep into most of these things, but like most of our clients would advise them when it comes to withholding taxes, especially those in the financial institution that have huge withholding taxes that they need to remit. We just tell them, just go to your fees and commission, fees and commission expense, add everything together, charge, look at the withholding tax amount, check how much you have remitted. So even when you have not paid it, just remit it. Maybe you eventually pay it. Just for ease of, so people are finding ways to because everything will net off eventually, right? So, and again, beyond all of this, accountants have even found way to adjust all of these things through deferred tax. You see, what Mr. Kazim is teaching you around deferred tax is it's actually an accrual for tax. It's not a tax you actually pay. Those things he was explaining to you, okay, the way the taxman deals with it, the way the accountant deals with it, there is difference, that is temporary. Fine, but you see, ultimately, deferred tax is just acknowledging the fact that there are some transactions that that will not happen, that the taxman might not allow this year, but they will allow it next year, right? So we, accountants, we recognize economic activity. The fact that those transaction has happened, even if the taxman says he's not going to allow it, we need to accrue it. That's deferred tax. Deferred tax is an accrual for tax. But let's leave those stories. But intelligent question that you have there, and it will be a long discourse. We can continue discussing this over and over again, but we have found ways to resolve these things in practice that it poses little challenge, sanctity of reporting, both for the tax people and for the internal accounting that we have as at today. So it's not really a challenge for us anymore.
Thank you. Thank you.
Oh, very good question. I like that. Okay, so usually when you are presenting your statement of financial position, your non-current assets will always come first. That is how we present it. Your non-current assets will always come first. And it's always presented in such a way that the asset that is so difficult to sell or to convert to cash is what we'll start from. That's why we are starting from. When you look at these non-current assets, we started from PP, goodwill, then it comes down. Then before we get to current assets, inventories, trade receivables, other current assets, then eventually cash. Cash is the one that came last, okay? So you see, separating assets, not just assets, even liabilities too. When you go to the liabilities section, they also classify that also into non-current and also current, in such a way that the liability that it will take us many years to settle, those ones will come first. The liabilities that will settle immediately, those ones will come last here, right? So you see, the whole idea behind this is that businesses is a continuum. This entity will continue to operate into a going as a going concern. And IS1 says that all entities that has a defined operating cycle must present their assets and liabilities in order of current, non-current distinction. I will repeat that. All entities that has a defined operating cycle. When I say defined operating cycle, is that you know when transactions start and ends. It could be 3 months, it could be 4 months, it could be 1 year, but I mean, you can trace that, okay, from when I buy from my supplier till when I raise money to come and pay back my supplier from maybe I sold and all of that. There's that cycle exists for you as a company. If you have that kind of cycle that you can say, oh, it takes me 10 days to complete a transaction, it takes me 15 days to complete this transaction, then you have to present your statement of financial position, specifically your assets and liabilities, in order of current, non-current distinction, right? It has to be like this, because we believe that, okay, if you have a cycle, then businesses will continue, and we can easily track those your periods. However, that's not emphasized here because it's not even emphasized in your syllabus. There's another presentation format for banks and other financial institutions, especially those in financial services. So those ones, they don't present their assets and liabilities in this manner. You find them presenting it in order of liquidity. It's like the reciprocal of what I've presented here, right? In such a way that the cash and cash equivalent that is ending under current assets is what will now start. And they will not separate current from non-current. They won't separate it. They will just present assets. They will list them. Pick financial statement of any bank. You will see that that is how it is presented. And it is clearly agreed that banks don't have, their primary line of operation, they don't have a clearly defined operating cycle. Because you, as an entity or as a customer, you start transaction with a bank, immediately you open an account, and it doesn't end. So we cannot say that this is when a bank ends a transaction. It's continuous. Whenever you make payments, they make their charges. And when you have your money with them, they make businesses, give it to those that want to borrow and use it for whatever it is they want to use it for. It doesn't have a clearly defined operating cycle for them. So for that reason, we cannot clearly separate their asset and liabilities into current, non-current. And again, for the fact that we do not know when their assets and liabilities or when their transactions start and end, why does that stop us from separating or classifying asset and liabilities into current and non-current for banks? This is the reason why. So IAS1 actually defined what a current asset is. I'll quickly like to show you that. So we're done with that. So it defined what a current asset is here. He said that a current asset is an asset that is expected to, that an entity expects to realize, right? Or intend to sell or consume in its normal operating cycle. So that's how this standard sees a current asset. It's something you should realize. It's something you should make money from. It's something you should sell within your operating cycle. And when we talk about operating cycle, really, it's different for most entities. It's different. So an entity that does not have an operating cycle or a clearly defined one for that matter, it's difficult to say that, okay, these are my current assets. No, or these are my current liabilities. And again, a current asset is held primarily for the purpose of trading. You are holding it for trading. That is a current asset. And in order to bring, agreement, because there will be a lot of disagreement if we just leave this one as, okay, operating cycle. Then they came here and says that, okay, it's a current asset if we expect to realize it within 12 months. So that solved the problem for most of us. Okay, within 12 months. So it's a current asset, right? Because some people will argue that, okay, my own operating cycle is 24 months. Some people will say 5 years. Then we restricted it within a period of 12 months. By the time it goes beyond, then it is not current asset anymore. It becomes something else. And again, if it's just cash and cash equivalents, then it's a current asset, except when the cash is restricted, right? So if you cannot have access to the cash for at least 12 months, then you cannot put it under current asset. So any asset that does not meet this definition, it's going to be a non-current. So we don't have a definition for non-current, but they define current for us. Don't forget, IFRS is principle-based. That was how I started teaching you. It's principle-based. Don't forget. So this is where principle starts. So nobody will tell you specifically that, okay, these are current assets. No, it's based on this definition. It is you that will know that, okay, these are the assets that I hold for trading. These are the ones that, okay, that I am expecting to make money from them within 12 months. And I have some cash, but I have invested it, and I cannot have access to it within 12 months. you will know that those ones they cannot be current. Those ones will be non-current. Okay, and I gave you some examples here. Inventory, trade receivables, cash, all things being equal. Inventory for a business that wants to remain in business, you should sell your inventory within 12 months. You should sell it within 12 months if you want to remain in business. So it's a current asset. Why non-current are all this? You see, you would get used to all of this because after today now, I will start teaching you all of these standards one by one. I will teach you IS 16 PP. I will teach you IS 40. I will teach you IS 38. Mr. Kazim, by virtue of IFRS 3, IS 27, IFRS 10, you will learn a lot about goodwill. You also teach you investment in associates, IS 28. I'll teach you IS 2 inventory. I'll teach you about IFRS 9, financial assets. Cash and cash equivalents also are covered on that. So you are going to learn each of them one by one. You will understand how you recognize and measure them. But this is just a general guide for presentation. So that's current asset. Current liability is quite similar, but I mean, the liability is something you would have to settle. It's not you collecting money now. So if you expect to settle the liability in your normal operating cycle, then it is current. If you are holding it for the purpose of trading with it, it is current, not for using in your company, for trading. It is current. And the liability is due to be settled within 12 months. So, I mean, that has helped us that, okay, settle in your normal operating cycle so that too much intelligent guy will not come and say that, okay, my operating cycle is 13 months. My operating cycle is 15 months. And these are the items I expect to settle within 15 months. Can it be current? We will say no, because it has stated clearly here that it has to be settled within 12 months. So for an operating cycle to qualify here, then it must start and end within 12 months. Then you put it as a current liability. And again, you must have an unconditional right. Sorry, you must not have an unconditional right to defer settlements. It's not something you should be able to defer. By the time you can defer it, then it becomes a challenge. It becomes a challenge for us because that will not be a current asset anymore. It becomes non-current. You should not be able to defer it within 12 months. So any other liability that does not meet this definition becomes a non-current liability. And I gave you some examples here for non-current liabilities. At least I can say categorically that Mr. Kazim has taught you this, deferred tax, and Mr. Kazim has taught you this, current tax. They would ask it in the exam. I'm very sure of that. You would see income tax. Very sure. So you need to understand how to determine current tax. You need to understand how to determine deferred tax. You need to understand these things. If you know it very well, it helps. I will teach you long-term borrowings. Of course, you will learn about provisions, IS 37. You will learn about bonds and debenture when I teach you IFRS 9 for financial liabilities. So most of these things, you would get used to it. That's where we are going after today. Okay, so that's a current asset and a current liability. But for now, you are learning that this is the template here for us. And the ones I told you for banks and financial services is not in your syllabus. I will be shocked if I can ask you something like that. I've never asked, right? So, but know that when it comes to statement of financial position, generally we use current, non-current classification for your assets and liabilities. But there's a classification called order of liquidity, right? That one is popular for financial service industry or for entities that does not have a defined operating cycle. Okay, so in your statement of financial position, we expect your total assets to equal your equity and liabilities. I've spoken about liabilities down here, but there's something called equity, which comprises your share capital, your retained earnings, and other components of equity. And also, you're going to learn about NCI. NCI is also a component of equity. Kazim will teach you pretty much everything you need to know about that. And I'm sure he loves it so much. He will spend a lot of his time teaching you that. Okay. So that is the statement of financial position. So ultimately, you find out that your total assets will equal your total equity and liabilities. Then we have our statement of profit or loss, right? So you see the name of the company in the title of this statement, and here I call this statement of comprehensive income is allowed. Okay, you can call it statement of comprehensive income. Sometimes they call it statement of profit or loss and other comprehensive income. And this one will be for the year ended. Is different from your statement of financial position that is as at. This one is for the year ended. So you would have from your revenue, deduct your cost of sales, your gross profit, other income, distribution, admin, other expense, finance costs, share of profit of associates, income tax. Then you have your profit from continuing operation. If you have discontinuing operation, you present it separately. Then you have profit for the year. Then you present your other comprehensive income. Okay. So other comprehensive income now is different from your statement of profit or loss. Okay. And I've told you when I was teaching you conceptual framework that this other comprehensive income will comprises income and expenses arising from changes in the value of an asset. And out of all these I've mentioned here, the only one I will teach you in this class is gain on property revaluation. That's the only one you will learn. Every other one, you will learn them when you get to professional level. Or maybe I think we might talk about available for sale financial assets, which are financial assets held at fair value through OCI, but we would learn that as we move forward. So you see this P&L, they have classified the expenses by function based on what those expenses were used for: cost of sales, distribution, admin, by function. Right? This is one that is popular. This is the one you would find in your exam. So this is the one, most of your questions, this is what you would see, because this is what you find most entities present. But let's have in mind that there's another one called classification of expense by nature, where they will classify your expenses into material, labor, and overheads, just like you have learned in your operating statements in performance management. Similar to that. So here they'll have changes in inventory of finished goods and work in progress, work performed by an entity and capitalized, raw materials, then overheads, staff costs, depreciation, impairments, and all of that. It's been long. We see a question that it's been very long. Even if you see something like this, eventually we can still present it this way. We can still present it this way eventually, because all of these raw materials, work performed, your inventory, you just present them as cost of sales. While all these employee benefit, depreciation, you put them in admin and distribution. So I won't dwell so much on that, but that's your statement of profits and loss. And there's another one called statement of changes in equity. So these statements, normally you would prepare it before you present your statement of financial position, right? Because it's the balances in these statements that you take to the equity section of your statement of financial position. I will repeat, is the balances in your statement of changes in equity that you will take into the equity section of the statement of financial position. So you will see that it's plenty here, right? Don't let that scare you. The one you will see at your level, it will not be so much like this. It's usually very scanty and straightforward. So the concept behind statement of changes in equity is just to explain, let us see the movement between your equity at the beginning and at the end. And when I say equity, I'm talking about your share capital and your reserves. Then your other components of equity, your share capital, your retained earnings. For this translation of foreign available for say financial assets, cash flow hedges, evaluation support, these are other components of equity. And all of these items came from your P&L, from this other comprehensive income. Note this, all items in OCI, right, they are usually transferred directly to equity. Remember, your profit too, you transfer it to equity. Okay, you call it profit for the year. So this OCI too, just for us to separate our normal profit from the ones that is from revaluation or changes in value, they call those OCI. Those ones, they go to equity as well. Just that we just separate them. We call them other components of equity. They are coming from OCI. So we'll present all of them in a tabular format. Even your NCI too will be there. You have your total equity. So, and the whole idea is that just reconcile it. You tell us your starting from share capital. Okay, what's your share capital at the beginning? Then what increased it? Did you issue additional share capital? Or how did they increase? Just show it. The same thing for your retained earnings. Tell us, okay, what is your retained earnings at the beginning? Then explain to us, how did they increase? So if there was a profit for the year, tell us. If you paid dividend, you should tell us. And just explain what cost movements in each of these items. So when we solve some questions, you would see what we are talking about. And also, when I teach you about IAS 8 accounting policies, you will learn that retrospective application of accounting policy is usually done through equity. It's usually done through equity, through your opening retained earnings. But you would see them again as we move on. Today is just for you to see the structure and introduce them to you. Finally, talking about the structure and content, you will see that in all the statements that I've shown you, the name of the entity must start first. You will see ABC Group. Then the title of that statement, Statement of Financial Position, as at, is important for us. And the period, the date you are preparing it to, very important. If you put it in the exam, I think they give you half mark in the exam. Half. It's very important you put it. Then, comparative period. You will see this one, I have 2017 and 2016. Comparative information, very important. Another one is the currency. This CU you are seeing under this year, it means currency units, whether Naira, depending on the country that I'm teaching, will determine. So it could be Naira, it could be dollars, it could be pounds, whatever currency, put your currency there. And you will see this comma 000. We call that level of rounding off. Level of rounding off. Because there are some companies that make a lot of money, trillions of naira. So we want them to be writing 1,729,852,000,000. Round it up. Round it up. So it could be in thousands, it could be in millions, the highest, and it could be in billions, B. So if it's in million, I will not, instead of these 3 zeros, they will just write comma M or iPhone M, like that. You will see as we go ahead, you will be getting used to all of these items. But these are things we follow religiously. In the exam, if you don't follow it, it can make some people not to pass. This level of rounding off alone. All your figures are correct, but the examiner told you 350 million. You wrote 350,000 like thousand, but you now forgot to put 000. Your figures are wrong. Even though they will give you correct your methodology, they will give you marks for it, but your figures are wrong. So that's that for that. So by the time you look through most of these things I've explained, you can look through them in my notes. All of them are there. So that's that for the statements. Now let's solve some.
Sorry, sir, I can't see your screen again.
Oh, you can't see my screen. Is that to everybody?
I can see it.
I can see.
Joy, why can't you now see my screen?
I don't know. It just went. Okay, it has come up now. It went blank all of a sudden.
Well, okay.
Thank you.
Okay, so let's solve questions now. Do you have any question? Okay. Now, so usually your number one question would usually require that you present or prepare financial statements. Either P&L or balance sheets, which of course statement of financial position, statement of changes in equity. So they will give you a trial balance and they will give you some additional information. Then they will ask you to prepare those statements. Or they can ask you to prepare a statement of cash flows. Right? It can't be the two together because statement of cash flows takes time. So Mr. Kazim will teach you that dedicatively, how to prepare statement of cash flows. But the one that follows one another is P&L, your statement of financial position, your statement of changes in equity. So even though you need to have good knowledge of P&L and statement of financial position so that you can understand what they are teaching you in statement of changes in position. When you read some of these standards, they call statement of cash flows, statement of changes in position. And you will see when Mr. Kazim starts teaching you IAS 7, all he'll be teaching is just changes in position. Changes between one year and another. That's your cash flow. Anyways, let's leave that. So our focus today is just to introduce you to the simplest form of presentation, just for you to learn, okay, where to put assets, where to put non-current assets, where to put current assets, where to put revenue, cost of sales. I just want you to get used to that structure. It's extremely important for us. So usually here now at your level, we are going to be starting from trial balance. Then from trial balance, you'll be required to prepare a published account, right? Of course, after making some end of the year adjustments. Okay. So in this question called End Time, that's the name of the company. They gave us a trial balance for the year ended December 2020. They gave us the currency, and the level of rounding off here is million. is millions here. So these are the items given to us. And it said that you are required to prepare statements of profit or loss and other comprehensive income and statement of financial position and statement of changes in equity for the year ended 31st December 2020. Okay, so this one is a very straightforward one. It won't come like this in the exam. So how do we prepare these our statements? So of course, because I've solved it, so usually you start from here. Your statements, the name of the entity, very important. The title of the statements, I put it as statement of profit or loss and other comprehensive income. You can also put it as statement of income if you wish. Put it. Then for the year ended 31st December 2020, and you will see my Naira and my level of rounding off. Don't joke with this, please. Put it there for them. Then we are preparing your P&L. The first item is always your revenue. I will go to my trial balance. Revenue, they always give you first, not always. They could put it anywhere. So you are the one that will know that, okay, the first figure I need here is revenue. This amount here, just transfer it to your statements. Revenue, 226, 625. That's my first statement, or my first item. So you need to know that after your revenue, the next item is your cost of sales. Go back to my trial balance. Thankfully, I have my cost of sales. Not in all cases, they will give you cost of sales like this. So they might want you to calculate it yourself. Is there anybody in this class that knows how we can get cost of sales? If we will not give anyone?
Can I try, please? I
Yes,
don't
please
know.
try.
So,
Please try.
I think through your trade payables and purchases, I guess so.
Okay, that's a good idea. I mean, I've had purchases. Okay, yeah, it's a part of it. It's a part of
If
it.
you have, yes, sir.
Yes, I'm on.
Yeah, if we have our opening stock,
Okay,
we'll add our purchases,
okay,
less closing stock.
okay,
We'll have cost of goods sold available for sale.
okay.
Then
That's all. You're
that's
correct.
all.
Yes, you're correct. You're correct. So there could be more. You would solve questions like that, right? So you're absolutely correct. So your opening stock plus your purchases. If there is carriage inward, you add your carriage inward. If there is returns outwards, you will remove your returns outwards. By the time you accumulate that together, you will get your cost of goods available for sale. Then you remove your cost of sales. Sorry, you remove your closing inventory, right? Then that will give you your cost of sales. And sometimes, some funny examiner might give you manufacturing wages. You have to add that also to get your cost of sales because it's a direct cost. So, but in recent time, when I say recent, 2 years, they have not done that. They have not. So they give you cost of sales in the last 2 years. They give you costs directly. So, I mean, there is nothing wrong with knowing that component of your cost of sales. But here, so profit, which is it's this minus this, my revenue minus my cost of sales. And don't forget, if the question gives me returns in words, I would I will remove that from my revenue. I will remove that from my revenue. So may I ask you something, right? If, for example, now, let me use this to demonstrate. Let's say the question gives me, why is it in scattering? And collasts. If the question gives me, for example, returns, it gave me returns. So on the debits, it puts 2,000. On the credits, it puts 3,000 returns. Which one of them is returns inward, outward? That's a question. You just put returns. On debits, it gives 2,000. On the credits, it gives 3,000. Olakunle, go ahead.
Yeah, the one on the debit side is returns outward, while the one on the credits is returns inward.
Hey, that's a good trial.
Mm.
Do you all agree?
Am I
The
missing
one
it?
on the debit,
The other way around.
the one on the debit side is returned inward.
Okay. Olakunle, it seems they disagree with you.
No, I
Do
think
you
I
want to?
agree with you.
Oh, Joy, do
I,
you agree with Olakunle?
I think so.
Okay.
If the revenue
Is
is
there-
on the if revenue is on the credit side, what comes back is inward.
Fantastic logic. So since revenue is always on the credit side, Abi, and returns inward is what you remove from revenue, what came back from your revenue. So you wouldn't expect returns inward to now be on the credit. Abi?
Yes, sir.
I mean,
Returning
on that,
what should
sorry?
returning what should be on the debit side.
Exactly. Returns inward
Right?
should be on the
What
debit,
should be on the credit side.
and returns outward will be on the credit side. Okay.
Or you
Yeah,
call it return
perfectly.
on sales and
Okay. Thank you, Prof.
Sales return and purchase returns.
Purchase returns. Thank you very much. So what about these discounts? They gave us discounts, 3,000, 2,000. So the one on the debit, what is it?
Allowed.
And the one on the
that's
credit,
yes.
On the credit is received.
Yes.
okay. How did you know? What was your
The one
logic?
on the debit side is expenses, while the
Thank
one on the
you.
credit side is an income.
Thank you very much. Thank you very much. So anything on the debit, I mean, expenses are always on the debit, then income will always be on the credit. Another one is this bank balance. It's on the credits. What does it mean?
That's an overdraft.
That's an overdraft.
Yes,
Fantastic.
correct.
Correct. Fantastic. Now, these trade receivables and payables. Trade receivables and payables. There's 10,000. There's 3,000. Which one is receivables here? And which one is payables here?
Debit side is receivable.
And the credit side is what?
Payable.
Payables. Okay.
Debit side is asset while the credit side.
Okay, yeah, I get you. Okay, that's correct. I mean, you're good to go already. So after your gross
I'm
profit,
sorry, so I'm not okay with that too. What's the final answer?
for which
Which one
one?
is okay?
Okay, for the one on the debit is the receivables. The one on the credit is the payables. So trade receivables is always on the debit. In fact, assets is always on the debit. Assets, always on the debit. And trade receivable, don't forget, is a current asset. We learned it shortly ago. So the one on the credit is payables. Liabilities. Liabilities are always on the credit. So for those of you that are getting used to debit and credit, please pay attention. Now you're knowing some key things that's very useful to us all throughout your studies. Expenses and assets are always on the debit. Income and liabilities are always on the credit. Always. Please note that, at least know that. And go on. If that's the only thing you learned today, that's a lot though. So after my gross profit, I have my other income. So for my other income, I need to go through my correction, my trial balance, and know which one is other income. And since I'm talking about income, then I should focus more on the credit side. So items on the credits, because those are the ones that can be other income. So is there any other income here? I can see
Discount
discount
received.
received. I can see discount received of 2,000. Is there any other one here? I can see
Revaluation
rental
is
income. I can see rental income of 2.5 here. Rental income. Is there any other one?
The bad debt.
The allowance for doubtful debts. Allowance for doubtful debt. Is there an income?
Bad debt recovered.
No, so
Where is bad debt recovered here? Okay, is this allowance for doubtful debt you are calling bad debt recovered? No, no, it's not bad debt recovered though. Allowance for doubtful debt means that we are just estimating that some of our receivables might not pay. So
Okay, that
ordinarily, this will be removed
should be
from your
provision.
trade receivables. Sorry?
That should be provision, sir.
Similar to that, even though it is not provision. Even though it is not provision, you are going to learn that very soon. But I mean, if that's how you know it for now, it's okay. It's still allowed, but you need to improve before November anyway. But again, it is not an income. It's on the credits just for the mere fact that it will be deducted from your receivable. So it cannot be on the debit, right? So that is all the income we have, the other income we have here. And I've shown it in my workings here. Under my other income, I put my rental income and also my discount received. And that gives me 4,500. Okay, of course, you will see that I don't joke with these millions naira. It's cost me nothing for me to put it on top, right? So that the examiner will know that I'm not joking here. So other income, this one in bracket means note 1, 4.5. Then my administrative expenses, I go back to my trial balance. This guy gave me my administrative expenses as 26,200. Okay, so we need to carefully check if there are other items here that I need to add to my admin expense. We need to look at it. And of course, I will just focus on the debits. Me, I've looked through every item on the debit. And I don't think I find any item I want to add to this 26.2. Can you find any?
How about distribution expenses?
Is a separate classification. From admin.
It's material.
Yes, exactly. Material. So what I would have expected us to argue here is this discounts. So please, this class, if you want to really make the best quality out of it. Let us disagree. Don't agree with me. Say, no, it can't be like that. I will say, yes, it can be like that. In this class, is superiority of argument. Eventually, you will learn. Everybody will learn. But eventually, I'm the one that will teach you. That one is sure. But, I mean, for the fact that you are coming up with arguments, you will never forget. Never. Like the kind of question Orobo was asking me the other time. Brilliant questions. He was making his point. I was explaining like that. I want everybody to be like that, even though I know you're tired this evening already, but just try your best so that this is our third class now. We have 14 classes to go, 14 classes. So it's not so long, but that 2 or 3 hours we'll spend together, let it be quality. Participate, don't sleep. And the only way is by asking questions. Just stop me whenever you want to. I won't get angry.
Sir, even if it's foolish
Hello, sir.
question.
Yes, even if it is foolish.
Hello, sir.
Yeah.
Yeah, I'm with you. I'm on.
Yeah. If we had purchases, then the discount would have played out.
The discount will have cleared out. If you add purchases to what?
If we had purchases, if we're coming from opening stock at purchases, we would have removed the discount from the purchases.
No. No. We don't
So,
remove
Discount is
discount.
an expenses.
Yes, in fact, that discount here is even an expense. So
okay.
purchases too is an expense. So you cannot even remove it. You cannot remove it.
Okay.
So
Discount given is an expense on us.
yes,
Okay.
discount allowed. So purchases is a direct cost. It goes in determining your gross profits. So what I wanted you to argue with us together is that this discounts, can't we treat it as part of our admin?
No. It should go for distribution expenses.
Why? Me, I
Selling
want
and
to treat it
distribution
as admin.
expenses. It has to do is as a result of sales. So it has to
Discount.
go with selling and distribution expenses.
So if I don't sell, I cannot allow, or if I don't buy, I cannot allow discounts. Is that what you're saying?
I think so.
Yeah. I think your point is logical enough. I think I want to agree with you. Discounts. I mean, it's not totally encompassing because there are some instances where you can get discounts for compensation. I mean, the guy is just giving you just so that you can come and buy next time.
As a result, you have bought before. So it has to do with
Because you're
sales.
buying.
You can't disassociate discount allowed
From
from
distribution.
sales and discount received from purchase. It is not. You can't disassociate.
Are
If
you
you have
sure?
not bought or sold, discount will not even come up.
Okay, I think you have a superior argument there. So I will go with you. So for us, there's nothing to add to our admin. So I'll just put my admin as 26,200. So now for my distribution, based on Amon's arguments, so now I know that they gave me distribution expense here as 12,300. Immediately I know that I will add my discounts allowed. Abi? So aside my discount allowed, is there anything we see that we can add to this distribution? I don't see any other thing here. I don't see any other thing here. So, and for my distribution, I already put it here. As per trial balance 12,300, discount allowed 3,000. So I have my distribution expense 15,300. So by the time I add my other income, I remove my admin expense, I remove my distribution expense, then I will have my profit before interest and tax. PBIT, profit before interest and tax. Then my question to you is this. What is another name for PBIT?
EBIT.
Operating profit.
Thank you very much.
Accessible profit.
No, not accessible profit too.
Operating.
Is operating profits. If that's what you said, you are perfectly correct. Operating profit. So take note of that. Anyone will go here. Then, after your operating profits, if you have finance income, like investment income or interest received, you add that. Then, or you have finance costs, you remove that. So, do you have any finance costs here? So, finance costs are like bank charges, interest expense. So, do you have any finance costs here? In fact, there's one here. 5,500. Did we show the workings here? So, finance costs, 5,500. 5,500. So I just don't want to stress you today, Neil. There is another finance cost here, but I don't want to stress you for now. Or can anybody spot the finance cost? Anybody?
Let us look at it very well. Yes.
Which one?
5%, 15% preference share.
How about you? This guy. Take note of this guy. This guy is auto. I take note.
Yeah.
Actually, nice one. That's absolutely correct. Absolutely correct. Yeah. So I will just leave that for now intentionally. I just want to keep it simple for today. But yeah, 15% of 30,000.
It's true.
Because it's
It's
something
true.
you
The
pay.
15% is the
Yeah.
preferential.
Yes, something you pay every year. Every year. It's finance costs. Fantastic. Nice one, Techno. So for simplicity, let's just leave our finance cost at 5,500. Then I have my PBT. What's it?
Why
Why
are
what?
leaving it at 2,000? Because why are we not adding the 10% share?
Okay, we should not leave it, Abby.
No, I'm just asking, why did you decide not to include it?
Because I will still teach you later. I'm just trying to present the very obvious one for today. I mean, get used to the ones that you can see straight on. So the derived value from the ones that are here, I will still teach you that as we move on. So like this one now, it's a separate topic that I will really touch very well. So when you
Okay.
sit in the exam, you would be able to treat it properly. Don't worry.
All right.
Yes. Okay. So finance costs, 5. After I add my finance income, deduct my finance cost, then I have my profit before tax. Then, after my profit before tax, I will then consider my income tax. I know that Mr. Kazim already told you that income tax is an aggregation of your current and deferred tax. Current and deferred tax. So now, let me go to my trial balance. The trial balance will always specifically state if I have current tax, it will state it there. If I have deferred tax, it will state it there. Separately, it's never combined because they are distinct items, very different. So do I have current tax here or do I have deferred tax here?
There's different tax there, 4,200.
Okay. Now, this deferred tax that we have here, it cannot be treated as an expense because it's on the credit.
Different tax liability.
It's a deferred tax liability. It's a liability. And again, you will learn, and because Mr. Kazim has taught you, that deferred tax is always gotten by comparing your opening deferred tax with the closing deferred tax. The difference will give you either a deferred tax expense or a deferred tax income. It is those ones that go to P&L.
Yes.
Difference between opening and closing. This one you are seeing in the trial balance is the opening deferred tax. Is the what? Opening deferred tax. So these are an opening deferred tax liability. If it were to be on the debit,
Brought down from last year, sir.
if it were to be on the debit, it will have been an opening deferred tax asset. So, I mean, to cut the long story short for today, this deferred tax is not a candidate for P&L. Any deferred tax you see in your trial balance is opening, except the examiner tells you otherwise. Is opening. The closing deferred tax, it will always be given to you in the additional information. That is where the closing deferred tax will be given to you. That is one. Number two, let's assume that the examiner tells us that we have current tax. That we have current tax here of 1,500. We have current tax to the debit of 1,500. So I had to mute everybody because somebody, I think his speaker is speaking. So on the debit of 1,500, so if you want to talk, I think you just raise up your hand. I think that would be better. So this 1,500 here now, will it go to P&L? You know, we have already cleared deferred tax for the one you see in the trial balance. It will never go to P&L, never. If it is on the credit, it's an opening deferred tax liability. If it is on the debit, it's an opening deferred tax asset. So that one, it doesn't go to P&L. It goes to balance. It goes to financial position. Now, current tax, it was on the debit. Will it go to P&L? Okay. Alakule, go ahead.
Yeah, I think it will go to the P&L because ordinarily the income tax is supposed to be the addition of current tax and deferred tax. And there is an additional information that gives us information on the closing deferred tax. We would have net the one in the trial balance with the one in the additional information and add to the current tax that we are just putting, so that and then the total will go into the P&L.
Okay, your point is that this current tax should go to P&L.
Yes.
Do you all agree with that? Is there anybody that, if you know you disagree, just indicate. I just need one person to say, I disagree.
I disagree.
You disagree, Amon?
Yes, sir.
Okay. This current tax should not go to P&L. Abi?
Yes, sir.
Okay, if this current tax is not going to P&L, which current tax should go to P&L?
The rate for the current tax, I think, is given in the question. sir.
No, it wasn't given.
What
They
rate
didn't.
are we going to? We're supposed to apply a rate to our profit before tax, after tax.
In
Profit.
Nigeria in Nigeria is 30%. But don't
Okay.
forget that 30% is applied on accessible profit, not PBT.
Okay.
Yeah.
I
So
think is
you
it
can't tell me which current tax will go to. So that means you have not been able to justify your claim. So Techno, you raised up
Mr.
your hand.
Hello, sir.
Yes, I'm with you.
Actually, the three classes taken by Mr. Kazim, I was not able to attend it very well. I still wait for the video to come out, but let me see based on my previous experience or knowledge.
Okay,
It
but
is not
the video is out already in case you don't, you're not aware.
okay. I'll check on that.
It's on YouTube. Yeah. Yeah,
Okay.
please go ahead.
I don't think it is a must that additional information will give us information. So either on the credit side in the financial position, and since it is a deferred tax liability, we have to adjust it with this current year tax. Since it is brought down from last year, it's a liability that we still owe some tax to pay. And we have to adjust it with this 1.5 to get the actual current tax for the current year that will apply in the profit or loss account.
Okay. That's a good trial, but no.
okay? So I don't know. I think the total tax expense for the year is what is going to go to the POL.
Which
That's
is
that's the addition of deferred tax and current tax.
we know, Joy, we know that. My question is this current tax that I put here of 1.5, if you had it in the trial balance, my question is, should it go to P&L? Olakule said yes. Amon said no. Then
It's
I
on the
asked Amon that, okay, if this one is not going to P&L, which one will go to P&L?
This current tax on the debit side is showing us that an under provision.
Fantastic. It is an under provision for tax. That's correct. But what do you mean?
So they probably, I don't know how to explain it though, but it's looking like they probably made a provision, right, for the tax expense for the year. But then the provision that they made was lesser than what was paid. I don't know if I'm saying the right thing though.
Oh, you're saying the right thing. You're saying the right thing. So, I mean, you have hit the point I want you to hit. So, on the basis of that understanding, so what goes to P&L? Is it this 1.5 or something else?
I think they will have to add this to the provision they previously had before to give you the total tax expense for the year that will go to the POL. And is it going to go to POL? Yeah, right? Yes, I guess.
Okay, thank you very much. You have helped us, and you are correct. That's actually what goes to our P&L eventually. But I know Mr. Kazim has taught you these things. I'm surprised very few of you are following. Yeah, but I mean, I'm happy that somebody gave me similar to what I wanted. So usually the way tax works, there is no way you can get tax in real life, even in the exam. The tax for the year is always gotten after you must have prepared your profits, give it to your tax consultant to compute the tax for the year, right? So what you actually pay to tax authority is what we call current tax, right? So that current tax, so we would need to, one way or the other, prepare our audited accounts, so that we can submit it timely to our shareholders. So we will rely on what our tax consultant prepares and put it in our accounts. In fact, we'll go and pay through Tax Pro Max these days, and that's what will be in our P&L. So theoretically, in your exam, they will give you that figure in your additional information that, okay, oh, this is the tax estimate for the year. That's tax estimate for the year. So usually that goes to P&L. The tax estimate for the year goes to P&L. So over time, the tax people will then come for DEX audits. That is where they will reconcile what they feel you should pay along with what you have estimated, your provisional tax, right? So eventually, it's either what you have done is right, no issues, or they will tell you that you have overpaid or underpaid. You have overpaid or you have underpaid. Eventually, that's what will happen. So in most instances, most companies will just clear over everything. It will go. Everything would nail off. Some will not pay. That's why in the trial balance, so when you are having a current tax on the debits, like I explained to you, and Joy was spot on the debit means that you had underpaid for last year. So you underprovided for tax. You underprovided for tax. So
debit.
yes, on the debits is an underprovision for tax. That's what you find. So if they give you current tax, it means underprovision for tax. So what goes to your P&L is exactly what Joy has said. That underprovision plus the estimate for this year. That underprovision plus the estimate for this year. I'm just cutting the long story short because I expect that you should have learned this before now. But the way you treat it here, when they give you current tax in the trial balance is an underprovision if it is on the debit. And you add that to your current tax, to your estimate of tax for the year, which will always be given in your trial balance. In the additional information that you cannot find in the trial balance because it's usually determined after you have gotten your profit. So they have already closed the books of accounts. They have already done the trial balance before that tax was determined, right? So that's why in the exam, they will always give it to you in the additional information. So most companies might not even have a GL for it for that year. They say, okay, give me the GL of your current tax. What are you talking about? It was the tax consultant that did it later after the year. So we don't have GL for current tax. So you will not find it in the trial balance. So what you find in trial balance is, okay, whether they now came later. So that current tax under provision is as a result of last year issue. It's not this year at all. It's from last year. So when current tax is on the debit, you add it to your tax estimate given in additional information, it goes to P&L. If it is on the credits, that is an over provision. That you will deduct it from the estimate they will give you in the additional information. That is what goes to your income tax as current tax for the year. See, all of these things I'm saying, you are going to would do a lot of it. It's something we'll encounter severally. So you will get used to it before the end of these 14 weeks that we have together. So, but in this case now, we don't have current tax and we don't have any estimate of tax. So if you had current tax in the trial balance, just current tax, we will have taken it to our P&L. So Olakunle that said, yes, it should go to P&L. Yes, you are correct. Okay. If it's on the debits, you would just go and as a deduction. If it's on the credit, it will be an addition to my profit. So depending on how it is. But in this case now, my income tax is going to be 0. Then I get my profit for the year. That's it. Then I have my other comprehensive income. So the only item you learn in other comprehensive income at this level is revaluation surplus. And do we have revaluation surplus here? Yes, we do. Okay, yes, we do. But again, the revaluation surplus that go to P&L is the revaluation that happened here in this current year. This one is a revaluation reserve. In fact, any revaluation you find in the trial balance is a reserve. It's from the previous year. That does not go to your OCI in the current year. That's why this is nil. Any evaluation surplus that you would get here, it would be given to you in the additional information. You see, all of this thing I'm explaining, I've explained it here. Like this income tax, I've explained it to you here. This evaluation now, I'm explaining it to you here again. So the evaluation surplus that comes here is the one for the year, and they will always give it to you in the additional information. So, and that is why in my statement, it is 0. So I get
Hello, sir.
yes, Mr. Techno.
Can you please come again on that explanation?
So again, revaluation surplus that you find in the trial balance is a reserve. Is from the previous year. Remember I told you that any item of OCI goes to equity. So they become reserve. So the one you find in the trial balance is a reserve from the previous year. It's not relating to this year. What goes to your OCI is the revaluation surplus that occurred this year. And that will be given to you in the additional information. That will be given to you in the additional information. The one you see in the trial balance is a reserve. It will not go to OCI. It's not for the current year. Should I go over it again?
Thank you, sir.
Okay. So I get my total comprehensive income. I get my total comprehensive income. Okay, Techno, you want to ask another question?
Yes, sir.
Please ask.
Okay. The revaluation surplus that you said is from the previous year now.
Yes.
And if there's anyone that occurred this year now,
yes.
Is it the addition of both that will now appear in the balance sheet?
Exactly.
Okay,
Exactly. Yes. But what is the one that happened this year that come to my OCI? P&L is about, that's why they call it for the year, is what happens this year. So after then, I go to my statement of changes in equity for the year ended. Here I have my share capital, retained earnings, evaluation reserve, then my total. How did I know that is these 3 items I will have is for my trial balance? Because those are the only items of equity. When I say equity is share capital plus reserves. So when you check my trial balance, I have ordinary share capital. Okay. Then I have revaluation reserve and I have retained earnings. Those are the items of equity. Me, in this class, I will not treat preference shares as equity unless the examiner tells me that it is an irredeemable preference shares. I will not treat it as equity. Because remember, when I was defining equity to you, I told you equity is a residual interest. Interest that you get settled last. So if the examiner does not tell me that this preference shares is irredeemable and it just presents it this way, me, I will not see this one as an equity, looking at the definition of equity. Because this guy gets 15% every year as finance cost. It's preferential. So that is not equity. So you will find out that all through my study or our study, I will always treat these preference shares as a non-current liability, and the yearly interest, I treat it as finance cost. Finance cost. You see. So, but for now, let's just look at statement of changes in equity. So my share capital
No,
at
sir.
the beginning. Yes,
I'm
Agoya,
sorry, sir. Can I talk, sir?
please talk.
Either irredeemable or redeemable,
Yes, sir.
both of them are preference shares and they attract interest.
Mhm.
So what is the rationale that you give to irredeemable and qualify it as an equity? What is the rationale?
Good question. So irredeemable means that we are never going to pay back the principal to this man. The shares is there forever. That's irredeemable. And that's equity. We are together for life. So if it is redeemable, that one is liability. In fact, if it is irredeemable, that 15%, I won't treat it as finance cost. I will treat it as dividend paid in my statement of changes in equity. So you will see. So again, my balance brought forward this 40,000, 16,500, and 20,000, giving me 76,500. I got all for my trial balance. Then my profit for the year, which is this 44,125, this 44,125. If there was revaluation surplus for the year, somebody asked, I will have come here, put revaluation surplus, I will have added it to that one I called reserve, but there was none here. So these are the items of equity we have. So totaling 126,225. Then my statement of financial position is that for my land and building, I have my 62,000. My plant, and this one is from the trial balance. If I want to show you, I just don't want to be going back and forth. So for my trial balance, where is my land and building? Yeah, 62,000. Land and building. Okay, land and building. And there's no accumulated depreciation on the land and building except for on plant and machinery alone. That's the only one. So my land and building, 62,000. My plant and equipment, 50,000. That is also in the trial balance. Then they gave me my accumulated depreciation in the trial balance as 13,875, which I will remove for my 50,000. By the time I accumulate all this together, I have my 98,125. Then I have my multi-users S&P and Sage. This is an accounting software. It's an intangible asset. Is in my trial balance, 5,700. Then investment property is in my trial balance, 15,000. If I add everything together, 118,825. Then my current assets, there was a plant held for sale. So this meets the definition of current asset and it's under IFRS 5. You will still learn it. So that's why it's coming under current assets. In my trial balance, it was 775.
As
My
a stock.
inventory, no, not stock. It's just still there as a plant. It's just like maybe they have a generator that they don't want to use it again. Now they are planning to sell it. Anything that you were using before in your business, but now you're now holding it for trading. IFRS 5 will come in and say that, okay, remove it from non-current. Go and put it as a separate line item in your current.
Okay, regardless either current or non-current, since it is held for sale.
Exactly. So 7.5. Then I have my inventory in my trial balance, 10,000. Then my trade receivables, it was 10,000. I need to remove my allowance for receivables of 2,000. That gives me 8,000. When I accumulate all of this together, I have a total assets of 144,325. Then my equities and liabilities. This my equity section. I don't need to stress myself since I will have prepared my statement of changes in equity. I'll just go and pick the totals there. So everything totals up to 126.25, which is, I just picked the total here in my statement of changes in equity. So 126.25. Yeah. Okay. Then my non-current liabilities, you will see that I'm putting my preference share capital as non-current, 13,000. My deferred tax is a non-current liability, 14.2. And adding them together gives me 17.2. Then my current liabilities, I have my trade payables, 3,000. That's my bank balance that was on the credit side. I put it as an overdraft under liability. Addition gave me 6.5. If I accumulate this 6.5 with this 17.2 with this 126.25, I get my 144.325, which is exactly the same thing as my total assets. If in the exam they are not the same thing, please move on. Just move on. Don't start looking for what you did not misplace. Just move on. So that's the end of this question. And that will be the end of this class. Your assignments, right? Even though the solution is inside this handout, if you want to help yourself, don't look at the solution, solve it yourself first, because it's similar to the first question I did. Go and solve question 2, just for your practice. If you practice it, it will help you a lot, right? Solve question 2. Then, so that question 2, I solved it in a more advanced way. That was when I introduced those derivatives as part of my finance cost. You see it there. And also the form part of my accruals. So try question 2. I'm always available for you if you don't understand anything. I'm just a chat away. So solve question 3, then question 4. Right? Solve those 4 questions. Please solve it. It will help you, right? Because from next week now, we are going to start going into standards. Look at it. I'm moving to IS 16 next week. And things will get more choky from there. So to pass FR is quite easy. It just requires that you start being consistent in your reading. I've done 3 classes with you, so realistically I have 14 more classes with you, and realistically that's the number of classes every other lecturer have with you. So the time is not so long. Start reading immediately. Start reading immediately. Start doing all assignments. It's a project you have in front of you. And God helping us, we're going to be here together. We're going to pass together. And we're going to come back in December or January to start other courses in more advanced classes. Okay, so I guess you can close the class for tonight. Then I will see you some other times. Bye for now.
Thank you,
Good
sir.
night.
Yeah, good night.
Thank you, sir. Good night.
Thank you, sir. Good night.
Thank you. Right.